Welcome to another deep dive. Today we're plunging into the world of Bitcoin, analyzing a recent intelligence briefing. It's dated August 7, 2025. Our mission for this deep dive, really, is to cut through the noise, helping you understand the powerful forces shaping Bitcoin right now. It's kind of a shortcut to being truly well-informed about its complex journey. Okay, let's unpack this. The briefing paints a picture of Bitcoin at a crossroads. It's balancing significant price rebounds with, well, a challenging economic landscape.
It really is. It's a fascinating tug-of-war playing out in the market, On one side, you've got these potent long-term tailwinds, things like increasing institutional involvement, growing regulatory clarity. But then on the other side, there are these clear short-term macroeconomic headwinds, inflation worries, new tariffs, stuff like that. Our goal today is really to connect these dots for you, illustrate how these sometimes conflicting forces are shaping the current market.
Okay, let's start right there with the immediate price action. Over the last 24 hours, Bitcoin showed some notable resilience. It reclaimed that critical $115,000 level, and it's consolidating around $116,000 now, posting about a 2% gain. This rebound, it came after a dip, right? Driven by institutional players, long-term investors buying that dip. It even pushed the crypto fear and greed index back towards greed. But I guess the question is, does this daily bounce truly signal a sustained upward trajectory?
Well, that's a key question, isn't it? When we connect this immediate action to the bigger picture, the technical analysis, it reveals a mixed structure, but an informative one. Short term, Bitcoin looks, let's say, weak positive. It actually broke below its recent rising trend channel. That suggests potential declines, maybe towards $110,386. And this is reinforced by a negative volume balance.
Negative volume balance. What does that mean exactly?
It means we're seeing heavier trading volume when prices are falling compared to when they're rising. It's a classic sign of underlying weakness, at least in the short term.
Okay, got it. So a bit of short-term choppy waters potentially, but what about the mid and long-term view?
Precisely. Medium term, the analysis suggests a hold. There's significant resistance identified around $120,000. Breaching that level is really key for any kind of sustained upward move. But here's where it gets really interesting. The long-term perspective. That remains firmly positive. Bitcoin continues to trade within a strong rising trend channel. That indicates sustained positive development, increasing buy interest among long-term investors. And the previous breakout we saw above $106,000. That technical signal still predicts a continued rise over the long term.
So why this apparent contradiction then? You've got short-term weakness, potential dips, but long-term strength. It feels like it's being pulled in different directions.
It absolutely is. That's a great way to put it. The market's basically in a consolidation phase. You have institutional dip buyers stepping in, preventing deeper collapses. They establish a kind of stable demand floor. However, these same institutions are highly sensitive to macroeconomic data. And that tempers their risk appetite, right? It stops them from aggressively chasing prices higher. So the result is less of a sharp V-shaped recovery and more of what you'd expect from a mature market. Volatility gets compressed between this institutional floor and a macroeconomic ceiling. Right now, the value is around $115,500, market cap about $2.29 trillion, sitting right in that consolidation range.
Okay, that makes sense. Now, beyond the daily price swings, the institutional front seems to be buzzing. After 4 straight days of outflows from the U.S. spot Bitcoin ETFs, nearly $1.46 billion out, they saw a net inflow of $91.5 million. And BlackRock's IBIT, it just continues to dominate, right? About 75% of the daily trading volume. That swift return to net inflows, even with all the macro uncertainties. That seems significant. But you mentioned the big story isn't just money flowing in, it's about how companies are now interacting with Bitcoin.
Exactly. What's fascinating here is this evolution. We're moving from simple adoption, just buying it, to a deeper financial integration.
Yeah.
Take Satsuma Technology. They closed a big funding round, $217.6 million. And nearly $125 million of that was settled directly in Bitcoin.
Wow. Settled in Bitcoin, not just bought with fiat raised.
Correct. This is a landmark. It's not the MicroStrategy model where you raise fiat currency to then go buy Bitcoin for the treasury. Satsuma actually accepted Bitcoin as a primary capital asset. That elevates it to a status almost on par with traditional currencies for investment, setting a really new precedent for capital formation.
That truly is a landmark shift. What does that imply, this primary capital asset status, for Bitcoin's broader acceptance in traditional finance?
Well, it implies a much wider potential market and utility. Instead of just being an investment you purchase with capital, it becomes capital itself. And then look at Paratax's holdings. They're set to go public via a SPAC merger.
Right, the faster way to list on an exchange.
Yeah, essentially a shortcut for private companies. They merge with a pre-existing shell company. And Parataxis aims to create a $640 million Bitcoin treasury firm listing on the New York Stock Exchange under PRTX. So this creates another publicly traded vehicle for investors who want exposure to corporate Bitcoin treasuries.
And it seems like even more conservative capital is getting involved. The Michigan State Pension Fund tripled its holdings in spot Bitcoin ETFs. That feels like a huge vote of confidence.
Oh, it's a powerful signal, definitely. Because pension funds have these really strict fiduciary duties. They have to be careful. Their allocation sort of de-risks the asset class. For other cautious investors, think endowments, insurance companies, it serves as a significant validation. So this whole progression from just passively holding Bitcoin to using it as an active financial tool, it dramatically expands Bitcoin's utility. You might hear some commentary like, oh, the Bitcoin as a treasury model has peaked, but that's not really a contradiction. It's more a sign of maturation. It's becoming less about a few giant whales making huge buys and more about thousands of institutional fish making smaller, more measured allocations through things like ETFs. It indicates a broader, perhaps more stable form of adoption.
Okay, that institutional picture is evolving rapidly. But now let's talk about the macro environment, which, as you said, still casts a long shadow. Bitcoin's price dipped below $113,000 recently following weak U.S. ISM Services PMI data for July. For listeners, that's a key indicator of economic activity in the service sector. And this weak data sparked renewed fears of stagflation. That nasty combination of slowing economic activity and rising prices. So it seems like while Bitcoin has its own powerful long-term narrative, it's clearly still sensitive to the broader economic mood swings.
Absolutely. And this raises an important question about how these different forces interact. It's not always straightforward. For instance, the U.S. also just imposed a new 19% reciprocal tariff on ASIC miners coming from Southeast Asia. That brings the total import tax up to 21.6%. This is a clear short-term headwind for U.S. mining operations. It increases their costs. And it could potentially shift some global mining power away, maybe towards places like Russia, as capital looks for regions with more favorable economics.
So a policy maybe intended to protect the domestic mining industry could actually have these broader, perhaps unintended consequences for the global Bitcoin network itself.
Precisely. However, if we connect this to the bigger picture, this kind of policy, while it feels protectionist, could paradoxically end up bolstering one of Bitcoin's core value propositions. Decentralization. Think about it. A geographically diversified mining network, one that isn't overly concentrated in any single country, is inherently more resilient. It's harder to disrupt through regulatory crackdowns or politically motivated attacks. So in a strange way, this could make Bitcoin more attractive to long-term investors who really prioritize that network security. And look, it's not all negative macro news either. The US dollar index recently fell to its lowest level in over a week. Since Bitcoin is priced in USD, a weaker dollar actually provides a natural tailwind for its price. It just illustrates this complex, often contradictory interplay of forces pulling Bitcoin in multiple directions at once.
Okay, so macro is a mixed bag, definitely something to watch. Another key piece of this whole puzzle is the regulatory landscape, and that seems to be moving generally in a positive direction, helping to de-risk the asset. The CFTC, for instance, announced it will permit the trading of spot crypto asset contracts on its federally regulated exchanges. This is part of Project Crypto with the SEC. You mentioned a virtuous cycle earlier. How are developments like this creating one?
Indeed, this specific CFTC initiative is huge. It would bring a whole new level of legitimacy and, crucially, institutional-grade oversight to the U.S. market. It essentially opens a pathway for established, highly regulated trading venues to list spot Bitcoin, which institutions trust. And it's not just happening in the U.S. Look at Brazil, a G20 economy. They're reportedly exploring a $17 billion Bitcoin reserve as part of their national economic strategy.
$17 billion for a national reserve.
That's the figure being explored, yes. And Bitcoin Indonesia is apparently pitching a sailor-style corporate treasury strategy directly to its vice president's office. Now, if countries actually start allocating even a small fraction of their reserves to Bitcoin, that would introduce a demand shock orders of magnitude greater than anything we've seen from corporate adoption so far.
Right, the idea of sovereign nations holding Bitcoin as a reserve asset. That's a massive shift in mindset compared to just a few years ago.
Yeah.
What's the broader impact of all this regulatory movement globally? You mentioned Dubai and the UAE too.
Yeah, Dubai and the UAE are partnering up to align their crypto regulatory frameworks. They want to create a unified, attractive environment for digital asset companies. It's all part of the same trend. So the broader impact. Each piece of positive regulatory news, like the CFTC's plan, or the clearer rules emerging in places like the UAE. It lowers the perceived risk, specifically the legal risk and, frankly, the career risk for the decision makers at conservative institutions. Think back to that Michigan pension fund. This encourages more participation from entities like them. Then, as more institutional capital flows in, the asset class becomes more systemically important. The industry's tax base grows, its political influence potentially grows, and this, in turn, incentivizes governments to provide even more favorable and clear legislation, which further de-risks the asset, attracts an even larger pool of investors. And the cycle restarts, but with greater force each time. This powerful feedback loop is definitely accelerating right now, and it's a key driver of that long-term bullish thesis we talked about.
Okay, that makes a lot of sense. Now, we discussed price, institutions, macro factors, regulation, but there seems to be a critical, maybe under-the-radar development occurring, a potential supply squeeze. On-chain data is revealing that Bitcoin reserves on these over-the-counter, or OTC, desks have plummeted, down to just 155,000 BTC, approaching historic lows. Here's where it gets really interesting.
Absolutely. What's fascinating here, and really crucial to understand, is why this matters so much. OTC desks, they're the places where the big players, the large institutional folks, make their block trades. It allows major buyers, think corporations, the ETF issuers themselves, to acquire significant amounts of Bitcoin without causing extreme price volatility on public exchanges like Coinbase or Binance. It's sort of a shadow market. So when the shadow supply vanishes, those large buyers, they're forced onto the public exchanges. This potential spillover of massive, often inelastic demand, meaning they need to buy regardless of price from the private OTC market, into a much more thinly supplied public market, well, that could rapidly absorb all the available sell-side liquidity. It basically sets the stage for a potentially severe supply shock and consequently rapid price appreciation.
That's a crucial point about the function of OTC desks. So if this shadow supply really dries up, what's the direct consequence for, say, a large institution trying to acquire a big chunk of Bitcoin? Does it just push them straight onto public exchanges? And what's the immediate impact then?
It absolutely pushes them onto the public exchanges. There's often nowhere else for that kind of size to go. And because those exchanges simply have far less readily available Bitcoin sitting in their order books compared to the total demand potentially coming from OTC, those large buy orders can quickly overwhelm the existing supply. That's what drives prices up dramatically, sometimes in a very short period. It creates a sort of vacuum effect. And compounding this supply pressure, you have the long-term holders. These are often seen as the smart money in the space. Data shows they are largely not selling into the recent market weakness. Their reluctance to sell further constricts the freely available liquid supply on exchanges. So it amplifies the potential impact of those dwindling OTC reserves. Less available to buy, and the big buyers have to compete for it more publicly.
Wow. Okay, this sounds like a fundamentally bullish signal, almost regardless of the short-term price noise. What does this tightening supply situation mean for those future price targets we sometimes hear about?
Well, exactly. While the day-to-day price action and macroeconomic news can often be noisy and confusing, this on-chain supply dynamic presents a very clear, sort of one-sided and fundamentally bullish signal. It's really this collision course, dwindling available supply meeting growing structural demand that provides the mechanical basis for some of those aggressive price targets you hear from Wall Street analysts, the ones projecting Bitcoin to reach $200,000, $250,000, or even $300,000 within this 2025 cycle. These forecasts aren't just pulled out of thin air. They're often rooted in models that try to quantify the impact of mass institutional and corporate adoption. They're effectively trying to price in the consequences of this impending supply squeeze and the new waves of capital being unlocked by things like the ETFs and the growing global regulatory clarity we discussed.
Okay, so wrapping this up, what does this all mean for you, the listener? This deep dive into the August 7th, 2025 market intelligence briefing really reveals a clear disconnect, doesn't it? You've got short-term volatility, often driven by that macroeconomic noise, versus this powerful long-term structural evolution happening underneath. The key price levels to watch seem to be support between roughly $110,000 and $112,000 on the downside. And then resistance, that key level you mentioned, between $117,000 and $120,000 on the upside. A decisive breakout above that resistance, above $120K, could really validate these underlying bullish on-chain dynamics and maybe signal the next major move higher. It seems like for long-term investors, the strategic posture remains focused on these powerful structural trends. The institutional adoption, the regulatory clarity, the supply dynamics, which seem to be strengthening almost daily, rather than getting too caught up in the transient, often contradictory macroeconomic noise.
That's a good summary. And it leads to, perhaps, a final thought to mull over. If this increasing integration of Bitcoin into traditional finance is creating a more resilient, more decentralized network, how might that fundamentally change its role in global economics? Going beyond just being an investment asset or digital gold, what other roles could it play as it becomes more deeply embedded? It's definitely a thought worth mulling over as we watch this space continue to evolve.